there's a great paper that was, I can't find out the guy's name. I read it years and years ago. It really speaks to all the stuff about big data and about finding the signal, the noise, and just basically paying attention. This guy was he was an economist going for his PhD, and he went to the racetracks. And at the racetrack, you always have a bunch of guys out in front trying to sell their news sheets, right? They're punters trying to say, hey, buy my news sheet. I'll help you pick the right horses.
Right.
So he went to them and he said, if I give you just a handful of data points, you choose which ones, but just use a very finite number of data points, make your predictions accordingly. And they did. And he took them and he looked at the results. He came back the following week, ran the same experiment, same people, but he said, this time, take a dozen data points. And did so, made their predictions, and the results were very, very interesting. On the one hand, the more data points that they could have and harness, the more confident they were in their prediction. The second thing, the worse their predictions were.
Right.
So it gets back to, you can overthink and you can overanalyze and you can just, like you were just asking me, sort of some of these keywords. I mean, ultimately, there's only a little bit of information that you need to get you where you need to go, and the rest of it starts actually distracting or creating noise. And if you can just land on the things that make sense, that pass that sniff test, and stay with them, I think that makes for better investors. And more success in sort of the people that I'm watching. That's kind of what they're doing is, you can have 100 data point models, but they probably don't get you any further faster than a 5 data point model.
You know what's interesting? I mentioned to you, I was talking to a physicist as well, and this phenomenon even exists throughout the universe, actually. It's the concept, imagine, if you will, that right after the Big Bang, it's basically information, even energy, atoms, that can all be essentially called information. So you start with a very small amount of information. And as the universe continues to expand, so does information. And information is expanding so much that we use a word in science called entropy to explain for almost chaotic information. And it's been man's pursuit to try to implement models to help understand this information. And in information technology, like data compression, like a zip file, like zip files, RAR files, if you compress information, anything that is a pattern is compressible. Anything that is too random is basically considered raw information. And if you just take a look at man's endless pursuits, economic paradigms, social, political paradigms, investing paradigms like Black-Scholes, for example, various different models in which man believes that he has developed the models to help him understand and condense information in a way that would be applicable. But then there's times when they don't work at all, and you continue then to get more chaos, more entropy. So I think that that's a very interesting parallel. And if you look at the history of the markets, you'll notice that initially there was not that much information. It was much more basic. I'm hearing sometimes in frontier and emerging markets, they're very basic. Sometimes it's just one stock that helps measure index. But as they continue to grow and they become more complex, people are striving to develop these models, and some of them are tangible. They follow the scientific method. A lot of them don't. And it's a very interesting way to look at things by looking at basically order and chaos. Chaos is information entropy. Order is models. And for example, E equals MC squared condenses the whole universe in one equation to some extent. And that's the beauty of science.
You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
We basically come from the perspective that there's a bifurcation between price and valuation for any underlying equity or indice or asset that we're examining. And we try to be as quantitative even towards the approach of, say, understanding the underlying fundamentals. But we recognize that price is also a key component to getting the capital appreciation you need. We run basically an open-end hedge fund. So, performance is the crux of what it is that we do. And sometimes, Andrew, I notice that there is a bifurcation between the two because you can believe something is worth XYZ, but price is not confirming it. And if you become too dogmatic about it, then you're going to be a house of pain in terms of performance. So I think one of the key issues was we had to deduct the concept of traditional technical analysis, which basically uses approaches of analyzing price, but the words are very deceptive. Technical sounds like it's technical, but in actuality, a lot of the tools used in technical analysis don't abide by, the scientific method or something a little bit more rigorous through some statistical testing or back testing. So we basically eliminate that almost school of thought, and we try to analyze price by looking at probabilities, by understanding, typical behavior and quantifying that. Very similar to, say, a baseball card where I can look at the S&P 500 and understand certain statistics and probabilities and histograms of things that are likely to happen that helps you navigate the day-to-day gyrations in the market. So that's from a price component. Now, I just had an amazing conversation with a physicist discussing about the ambiguous inputs that you use when determining valuation of a particular asset. And, as nice as a model might sound, it's impacted by your inputs. And then when you allow for sensitivity analysis, it creates more permutations, which then is basically more noise. And it makes it a little bit more tricky. So I think one of the key schools of thoughts that's missing is almost something that is like a general universal theory that allows you to assess both price and valuation. And we work, asset managers strive to, or at least some of them strive to address some of that. So I guess connected to all.
I got to disagree with you, man. It's all about just leveraging up, Peter. Isn't that really all it is?
What do you mean?
Isn't it? I think what you're exploring is a rational, factual way to do it, right? It's a long-term formula for success. And I think that the market, for the longest time, hasn't really necessarily followed that approach. I think for the longest time, it was just get leverage. Don't worry about it. I think stock picking, basically what we're talking about is valuation, and stock picking is coming back into vogue because, a rising tide floats all boats. And now that the tide's going out and QE's over and all this liquidity seems to be at risk, you have to step back and say, gee, there's a core value here and there will be a reversion to that value. What does that mean?
Correct. It's the tools that are being used, though, to ascertain this reversion, quote unquote reversion. And the issue is that, what methodology you're using that gives you as much of a statistical advantage as possible. I think that is the crux of the issue here. And actually the purpose effectively of this podcast series, which is get so many different perspectives to see what kind of tools are, I think are essential.
To be honest, where I came from, it was, I've got the classic economics background, but I said, I want to get my hands a little dirty, and I went into business. Where again, it was big data kind of stuff, applying we'll call it econometrics, but basically a data-driven environment where you're making decisions based on using the information that you harness, but doing it in a creative way and then applying it. That was my career trajectory. And what's interesting is while I do that, grab the data and point to trend at the aggregate level, you were just talking about, are there ways to use these kind of tools and new approaches to also go after, specific investments? That aren't, at the macro. And that's what I do also is I take that same data And so what I've been doing for a couple of years now is, I'll call it stock picking, but essentially by harnessing what I think are the right tea leaves, I look at individual companies and am able to fairly accurately predict when they're going to beat or miss their earnings. And, pretty good hit rate there. It's really interesting because, again, it's a question of, and this is the Moneyball thing, when you can come in with a fresh perspective, or take a step back and evaluate things sort of from the outside perspective, you have a chance to take a look at the entire framework of what's really going on and say, you know what, coming in from the outside with a fresh pair of eyes, these are the things that seem to matter the most. So let me track down the data that's going to get me to that, because this is a different economy. I mean, today versus 10 years ago, what we buy, where we buy, how we buy, totally different. And the global supply chain has been harnessed in a completely different way. But the folks who model the economy and the policymakers are using models that are pre-internet. Like literally every single person at the Fed who has a finger on the trigger got their PhDs before the internet existed. And so their frame of reference is horse and buggy while we're in the world of the automobile. And there's a lot of disconnect, but that's the opportunity. And so I've been harnessing what I feel are sort of, not feel, but what I've been demonstrated are better pieces of information and better ways of applying it. And, whether it's at the macro level or at the company, stock picking level, so to speak.
On the company level, do you think we could run by some generic example of what you would typically use to assess earnings? Yeah.
So one of the things that I bring to the table is sort of a Main Street. I've worked in business operations for Fortune 50 companies, and I've supported Fortune 500 companies. And what that means is I've gotten hands-on experience with what's on the executive's dashboard. What are the 5 dials they're looking at when they wake up in the morning? What are the things that are going to move them to action? And I've also been given that firsthand experience in 2 other things. One is not just how companies operate, which is key, because you get to see, by the time a company does layoffs, by the time Intel announces a layoff, for example, they knew about that 6 months in advance. But they had to go through certain processes to confirm that the business cycle was winding down. And then they had to go through legal and HR and so on and so forth. And so the goal is to get as far upstream as you can and get that visibility. The other thing, though, that I bring to the table is that experience of being in Silicon Valley. So again, we've had this shift. I mean, it's amazing when you think about how the global supply chain has been harnessed by the internet. So the internet really was first and foremost a warehouse management tool when it got its start. That's what Oracle really did with its software, was to give companies better line of sight to what they had in real time in their warehouses. And that's really been what the internet was all about, was information management, whether it was information about things or these days with Facebook, information about information. Twitter, it's just information. It's the CB radio of the 21st century. Hey, Peter, I'm going out and I'm going to get a coffee. Come on back. That kind of experience where it's not really doing anything. It's a lot of noise, but there might be a signal there. But, ultimately what happened in Silicon Valley is as the internet harnessed the supply chain, you start to see, just by being here, you start to see where some of the threads are emerging that are different from what used to be there. And one of them was semiconductors. When you really think about it, it is the universal common denominator now in everything that gets made or done. It either has a semiconductor chip in it, or a semiconductor chip was in the thing that made it or did it. And so if you look at Asia, where you are right now, semiconductors are the lifeblood for those economies. I mean, I can predict what the Taiwan Stock Exchange is going to be doing simply by tracking some of the semiconductor variables that I track. I mean, literally 1 month in advance. But in the U.S., it's not as straightforward because we're not as high-tech dependent, shall we say. So what I do is instead I harness a lot of different experiences here to take a look at a company and recognize, without kind of sharing the secret sauce, but there are certain publicly available operational pieces of information that you can pull together. The typical analyst is trying to do the same thing. They're trying to triangulate. We'll use Intel as an example. Hey, is Intel growing or shrinking? And what can I do to find out? So they might do channel checks. what's going on with Intel sales. What I'm doing is I'm saying, why do you want to wait until the thing is made and shipped and sitting on the shelves to find out if it's selling? This global supply chain is so tight that Intel knew before they even shipped it what the end user demand was going to look like. And so you don't want to wait till it's made and shipped. You want to go further upstream. You want to go practically to whether the semiconductor components, the wafers, the actual, 6 months in advance before the chips get made and sold in the PC, you want to be able to tap in. It's kind of like, let me use a more straightforward example. I don't want to know GM's car sales by looking at what they shipped to their distributors, to the lots. Maybe I'll look at the tire sales from Goodyear to GM, because the tires have to be there before the car's finished. So let me look at some of the subcomponents first. And then maybe instead of just looking at the tires, maybe I'll look at the rubber demand. And that gives me, knowing that it takes X number of weeks or months. And so what I try to do is harness that global supply chain. And specifically what I've uncovered is the power of the semiconductor to give that visibility and say, look, it always takes this number of weeks to make these chips that go into this thing. And it takes a couple months for this thing to get finished. And so in essence, what's going on today with semiconductors is giving me what's going on with consumer demand 3 months from now.
Andrew, let me ask, I'd imagine that this kind of analysis, I'm imagining that you're going to put certain weights to each piece of data, and it's basically causality to the next quarter earnings. Is that a correct assumption in which
Absolutely.
You're taking XYZ data point and a few, and then you go, this is the weight and impact it's going to have on the earnings, right?
What's interesting is it's not a complicated model. Right. What I've done is I've stripped it down. I mean, to be honest, again, you go to any given CEO of the Russell 1000, they all operate pretty much the same way. They're all looking at information that's coming in from their sales team that tells them what the end user demand is. Again, the internet has now enabled us to get forward visibility. And then there are only so many things that CEO can do. I mean, by the time we get to earnings season, let's just look at it from a procedural standpoint. We're 6 months into the new quarter by the time any given CEO typically is releasing what they did last quarter. When they're presenting earnings for what they just did, they already pretty much know where they're going to land for this quarter. What they do is then they're trying to manage the bottom line. The top line's pretty much set. There's not a lot that can change because, again, order flow and so forth, big companies, you're going to already have gone out and it takes a couple months to land that order and so forth. So they know what the top line's going to look like.
Right.
It's a question, what can they do to manage the bottom line to bring in the EPS where they committed? And so there are a couple things, again, without revealing the secret sauce of what I do, but there are only a couple things you have to look at, again, going back to my experience with the executive dashboards, to know exactly where they're going to be hitting the gas or hitting the brakes. And so what I've done is I've come up with, it took a lot of work, trust me, but basically I've harnessed what I think are the right data points to give me that visibility to what the CEO is thinking. And therefore, if I can see right now what they're thinking today and how they're acting, it's not just thinking, but what they're really doing, are they really tapping the brakes? Then I can turn around and say, look at what the expectations are, what the forecasts are, and say, okay, everyone knows Intel is going to have, I'm not beating up on Intel, I'm just Acme. Everyone knows Acme's doing badly, but maybe I've got line of sight that says, yeah, they're doing badly, but not as bad as everyone thinks based on what I'm seeing from this operational data that I'm looking at. And so knowing that CEO has the ability to fine tune a few things that will generate a penny or two of earnings, I can basically peel that out. Now, what's really interesting is some companies do it better than others. I mean, there's definitely some dogs out there where the management seems to be on autopilot, not really paying attention. I mean, if I were private equity, that would be where I would go. Is I would want to do an LBO, buy out those companies, get rid of management, and bring in a new management, because it would just instantly just put in some basic management process in place, and you'll see margins shoot up. But you can also see where the CEOs of these companies, some of them have to, a McDonald's needs to manage to today. They've got a lot of things that are going on today, and their business is very near term. Whereas consulting companies, information-oriented companies, you take the high-tech world, they've got to take action today for things that are maybe 3 to 6 months out.
Right.
And so there's a longer delay. And what that means is translated is I have visibility to a lot of what these companies are doing 6 months in advance. And So what I've been doing, I've been publishing this out in the public domain. Also, some of my clients get it in different ways. And I've been 60% accurate at predicting when a company's going to be outside the box, when they're going to beat or miss their revenue targets.
I've actually looked at customs transactions between two countries. This is not proprietary data on my side, so I can disclose it. And I've been able to get quite a bit. You can actually learn a lot between the public information that is curtailed to trading and transactions between even two companies or, distribution companies that have an affiliation with, say, the parent technology company. You can understand quite a bit. I do that because I'm here in Asia. The issue is that I typically have to have the information on both countries if you want the accurate data to, confirm and cross-check. Sometimes I haven't really been able to get it to that magnitude of accuracy that would make me feel comfortable that this is a worthwhile endeavor. But maybe, I guess my comment is that overthinking that situation.
No, it's so funny you raise that because today I'm actually putting together a report. I'm looking at a few of them, what I consider to be the key benchmark ports around the world. And I'm looking at, ultimately cargo shipments. I mean, at the end of the day, the economy really is dictated by buying stuff. Right. And not to confuse things, but it's exactly like what you're saying. If you start looking at trade, is stuff leaving the ports of Busan or Taiwan or from China, all the various ports there, what's happening over here in the U.S. and so forth. What happens is you don't have to be, we're not going for precision, like exactly this much came from China and exactly that much went to the U.S. or wherever. But you can get a triangulation that says, geez, and this is what I'm putting together today, is to say, we have a global downshift. And it's indicated, and it's not a lot of times you get this, it's easy to get lost. You lose the forest for the trees. Oh, this data point came out and everyone gets excited, or they get depressed. We have to look at the trend, and the trend has been downshifting for the better part of a year. And again, that's it's not a horrible thing. I mean, we've had a really good run. This is a business cycle. When we hit a huge number, it's the law of big numbers. You're going to slow down. But what you find is that every single major trading region is slowing down in the movement of goods. And that's a demand thing. That's not oil's down type of thing. That's playing into it a little bit. You have some pricing things and you kind of work your way through it. But I don't think that's overanalyzing at all. In fact, that's one of the basic premises of my approach, which is start with the supply chain. If we're moving things around, make sure that it's also mechanics. I like to do bottoms up. I like to make sure that what I'm looking at is apples to apples. I want to make sure, for example, when I look at U.S. trade, I'm going to strip out oil and autos because that distorts the picture. And everything else is sort of the core economy. So that's what I really want to know is what's the core economy really doing? And so I think it's totally the starting point. You and I are coming from the right place, I think, which is people buying stuff or not. Are they buying it more or less? And then you can drill down and start to see, well, are they, what exactly are they buying? And then I sort of shift to semiconductors because, again, as it turns out, especially when you're talking Asia, a lot of the goods that are really being shipped out are high tech. And, when you talk high tech, you're talking semiconductors. And again, you've got a very tight supply chain. So that's, to me, the prism for understanding trade is going to be semiconductor movements and demand. Now, bearing in mind, this is kind of a dog and tail kind of discussion also is, for example, one of the things I like to advise folks on is, you got to understand at some point, all roads lead back to China right now, because sometimes they're the dog and sometimes they're the tail. And for the U.S., China is the tail. What we do drives a lot of our business with China. Turn it around. Germany is the tail to the Chinese dog. What is happening right now, Germany's in a recession. It doesn't matter how we play with the numbers. They're recessionary. So is most of Europe. And a lot of that's because there really is a slowdown in China, and they really don't have much of a domestic consumption economy right now. When they buy, they like to buy brand names, luxury names. U.S. doesn't really make luxury goods. If you think of the luxury car market, you're not going to think Ford, right? You're going to think BMW. You're going to think Ferrari, Porsche. Mm-hmm. When you think foods, you're going to think French wines. When you think of clothing, apparel, you're going to think Gucci, Fendi. You're going to, in essence, think of all these things that are made in Europe. So as China has slowed down their consumption, the first place that got hit was basically Germany and Europe. Germany, because they don't just play in the luxury goods market, they play in the machinery market. These are all the things I think you have to start with. You have to start with the fundamental building blocks. There's a lot of other things that come into play. The retail investors and institutional investors, some of them are looking at the bond market, fixed income, and some of them are going to be looking at the equity markets. And there's always going to be other dimensions that come into play. But what's interesting to me is you don't have to get that complicated. I think there's a lot of overthinking that has happened. I think a lot of models have been built up that are extraordinarily sophisticated, but they don't really add much. There's this diminishing return on the amount of effort that's going into them. I mean, ultimately, Germany's an exporting country. Their stock market's going to be determined by the level of exports. So how do we find out what that level is going to be? Not looking backwards, but looking forwards. And so that's kind of the essence of Moneyball, is to come in and reevaluate and just sort of not get locked into things, but say, what kind of historical data do we have available? And what really ties back to what's really going on? If Germany's manufacturing autos and machinery, well, then I want to know I want to get to the subcomponent demand, because the subcomponent demand is going to have a leading capability.
Let's talk about Germany for a second, because I know you've been using these examples. For me, as an equity investor, I see the DAX making an all-time high. We understand there's a lot of quantitative easing that's happening, that's keeping equities in a very uber bullish situation. Now, what I'm hearing, and now I don't have the analytics behind that, but what I am hearing is that despite these events that are happening with Russia and Greece, that German exports are still doing relatively strong because of this quantitative easing environment. Do you understand different or otherwise?
Yes, I do. I have different data. So let me show. I have something that I call, it's an EU shipping index. It's a proprietary compilation of shipping data that is very, very sensitive and predictive. It's got a 6-month advanced view of the EU economy. And frankly, when we talk about the EU and we talk about shipping, we're really talking Germany.
Right.
They're the engine here. I think what's happening is we got to get back to what the market's responding to versus what the fundamentals are saying. And I think what the market's responding to is a roughly 30% drop in the euro relative to the dollar. Mm-hmm. So we're talking about Germany's competing with us when it comes to coal, steel, machinery, whatever. All of a sudden, they got a 30% price advantage. Of course, they're going to be sitting a lot better. And of course, the expectation is exports will be going up. The problem here is a premise problem. I think the narrative is if you somehow get some kind of currency advantage, then boom, you're off to the races. Except we've gotten almost 25 rate cut. We've got 25 central banks have cut rates. So we've got this currency war going on right now. China's done it. Japan's done it. Everyone's doing it. And this is kind of a zero-sum game. There's only so much steel that's being demanded. And worse, looks like that's shrinking a little bit. So you have everyone chasing a limited pie, thinking I've got this currency advantage. And yet it's just kind of moving the chairs on the deck of the Titanic. It doesn't matter. Demand is going down. So it's a relative advantage that is a short-term thing. There's only so much that Germany's going to be able to sell, and then at a certain point, they're actually contracting. And that gets back to what I'm actually seeing in the real data, not the expected change. Basically the market responding to, oh, well, you've got this great advantage now. BMW can now go up against GM easier or against Lexus or whomever it is over in China. They've got some kind of price advantage. Well, the reality is Chinese demand isn't there anymore. It really isn't. I mean, we can take the official data and you can hold it up to the light and make your determination about the reliability. But fundamentally, stuff moving in and out of Germany has been contracting for some time, meaning people are not buying German goods at the same rate as they were this time last year. They are contracting in terms of the amount of exports. And that's in the stuff that I look at. And that stuff that I'm looking at is the early indicators, sort of like looking at semiconductors. Again, you won't see that show up for a few months in the broader, more mainstream data points. But by Q2, Germany's in a full-blown recession. So is the EU. Everyone in Europe, they're not selling as much. It's a relative thing. Oh, Spain, we're doing better than we were last year. Gee, that's great, and I'm happy for you. But the reality is, from an economic growth standpoint, the utilization is just not there anymore. And there's a reason. So, I was in January, I was meeting with some folks, and everyone was getting excited about what could be the potential bazooka that was being used in the ECB. And I was looking at that, and my comment for the past few months prior to this was, it doesn't matter what's happening in the EU. It only matters what's happening in Germany. They have been the gatekeeper. They've been the only ones doing the thumbs up or thumbs down for anything that the European Bank will do. And the only reason that they were able to move forward is because, Merkel and her team saw, oh my God, we're entering a recession. Unless something quickly happens, we're in a bad place. That tells you a little bit more about the reality. The reason that they've gone out and done their version of QE is because things are really that bad. And Germany finally blinked and said, you're right. They really are bad today, and they can only get worse unless we take action.
Andrew, have you had a chance to take a look at Switzerland as well with this revaluation of the currency, or it's too small of a market for you?
To be honest, it's not that it's too small, George. I don't have good data. I don't bring anything to the table that other people have. And I can't really comment on it except to sort of sit back and say, wow, this is really interesting. To me, some of the interesting outliers are, it's like Brazil. How is it that Brazil has not cut their rates yet, considering that they're one of the supplier economies out there and their customers like China are not buying as much? They're at a weak place. The counterpoint to Brazil would be Australia. They were ahead of the curve in terms of cutting. They saw the writing on the wall and moved very quickly. And then you've got Japan. That's the other one that's an outlier to me, because last year I was saying we were going to see parity with the euro. And the euro was like at around 120. And I'm like, no, it's going to be parity. And with the yen, I've been saying it's got to be 140. They have to go even more nuclear. And up to now, China's been the one blocking that move. China was the one trying to keep them below 100. Sort of a blowback from the two of them going at it over trade and war issues. It's still sort of some. I think you're familiar with the cultural challenges between China and Japan and some of the issues that World War II still raises even today.
Right.
And China 2 years ago in 2013 was really putting it to Japan. They were, I don't know if everybody remembers, but you had a lot of riots. You had a lot of people striking. You had Toyota having problems selling and so forth. And so it's a very real thing. But they were also getting punished in the bond markets. Eventually, that didn't hold up. Japan is just basically punching way above their weight class. They have two problems. One is the most core one. This is the one I like to look at, is they don't make anything the world really wants anymore. And I think that's being masked in some ways. But when you think about the digital economy that we have today, there isn't one Japanese product that anybody wants. The TVs don't really come from Japan. Our consumer electronics don't really come from Japan. Networking devices don't come from Japan. PCs don't. When you look at this is interesting. I recently did an analysis. If you look at imports into the U.S. from our trading partners, over the past 9 years and over the past 4 years, there's only one country that has contracted in the nominal dollar amounts that they've sold us. That's Japan. You've got Korea shipped, I think it was like $30 or $40 billion increase over the past few years in terms of the amount of stuff that we bought from them. Japan, they're falling backwards. And it's because they've so disconnected from the world, they don't make things we really want. They make cars. They make great cars. But other than cars and some steel, what do they really make that people are really buying, in volume production? And so that's why, on the one hand, they've got this long-term challenge. They don't make things that the rest of the world is now enjoying. And I think Taiwan and South Korea are quite happy that that's the case. But when you talk about the yen, if you look at what happened when they dropped the yen, industrial production went up, exports went up. It was great for a while, but then after a year, it played out. That helps in the short term, and that's really the only immediate piece of ammunition that the central bank or anyone else has in Japan. Every time they bomb the yen, business picks up. And that's a short-term solution, but the long-term problem is if you look at their debt to GDP, you look at you start throwing in their demographics. This is a country that is going to experience what they call the Black Wednesday that George Soros had with the Bank of England.
Yeah.
Remember, Yeah, where basically their economy does not justify the value of the yen. It just doesn't, and there's no changing that. It's not a cyclical thing. This is a huge structural problem for them. Their economy is shrinking. It just is, and it's on a downslope, and it's going to continue on that downslope for at least a decade. I spent 4 years working in Japan, so I can sort of speak to this from a perspective of having lived and breathed business in Japan. They've lost it. They really have lost it, and yet their yen is strong. So for me, I'm just sitting there. We were talking about outliers like Switzerland. I mentioned Brazil. To me, it's just a matter of who's going to go in there and do that Black Tuesday. Who's going to be the Soros?
You know that a lot of people have speculated on some dramatic collapse, yet it hasn't really worked for people yet.
I know, and that's the question. And I think that in the case of Soros with the Bank of England, that was a very one-to-one. It was very clear who the players were.
Right.
I go back to looking at China as the hidden hand here, trying to prop up, and so is Korea to a certain degree, trying to prop up that yen and keep it. Because again, Japan does make things that do compete with Korea and China. When you looked at, for example, when the yen dropped from 80 to 100, what was interesting is if you look at steel shipments, suddenly Korea's steel shipments to Japan collapsed because all of a sudden Japanese companies were sort of domestically manufacturing and consuming. So you have that logical shift when you have that exchange rate change. There's a very big blowback that will happen if it goes to 140, and the players who get hit the most are going to be basically China, Taiwan, and Korea. And so there is, I mentioned China has sort of a love-hate relationship with Japan that played out. Then you have just the straight mercantilist thing. Korea does not want a cheap yen. It hurts them, because they do trade in some of the same things. And so I look at this and say, who's got the big guns here? It's China. They're the only ones that can prop up the yen, the only ones right now who are motivated to prop up the yen at this level. And eventually, you can't do it forever. But I think you're right. I mean, it's a timing thing, but you just sort of sit back and go, at some point in time, 140 is inevitable. But the market can outlast us, right?
Potentially, yes. Let's talk about hookers, right? And the Vice Index and some of your observation. Yeah. I thought that's a great tagline. Let's talk about hookers for a second.
Let's talk about hookers. Only talk though, right? This is all like
only talk.
Second hand,
no touching.
Second, yeah. Well, they do have their finger on the pulse of the economy. So no, it's fun to smirk and kid around about this, but there's let's take this reality. Yesterday, the retail numbers come up for the U.S. Do you know who was the number one forecaster for retail yesterday? Me.
Who? You. Okay.
I beat every single Wall Street pro out there, all 86 of them. I was the most accurate forecaster for retail, and it's based off of my Vice Index, where I look at booze, broads, bong hits, and blackjack. Mm-hmm. I basically look at gambling, drugs, alcohol, and prostitute consumption. It's a simple, quantified model, and it gives me not just I feel a better insight into what the American consumer is doing, but it gives it to me with a lead. I knew this information 3 months ago. I knew what the consumer was doing, and let's get kind of academic about it if we can. Let's start with the theoretical, and then I'll share with you how I get the data, because again, getting the data is the fun part. Again, it goes back to what's our goal, right? We want to track certain things out there because we believe that if we can get a hand on what people are doing or companies are doing with their spending, that gives us line of sight to some investment opportunities. It could be an inflection shift, could be, any number of things. What I realized is most economists would agree that luxury spending is that tip of the spear when it comes to consumer spending. That is the leading indicator, the ultimate leading indicator.
Right.
And, it's frivolous money. It's totally not a need. It's absolutely a want, but it's the ultimate want. It's stuff where you go, I'm just going to blow some money because I feel good. Well, the challenge with luxury spending, tracking it, has been, what do you track? So for the longest time, I think it was Morgan Stanley was tracking, it could be JP Morgan, I'm not sure. They had a luxury index, and they were looking at Sotheby's, Tiffany sale. In other words, they were looking at the 1% activity. And that doesn't really, especially in the most recent business cycle where we've had sort of a bifurcation of the economy, I did not feel that really spoke to, I felt it was too narrow a definition of luxury. One person's definition of luxury might be, really cool new shoes. Another person's is a yacht. So how do we find what everyone indulges in when they feel good and what they pull back on when they don't feel good? What's a luxury spend? I realize vices, they've been with us forever. Everyone indulges in vices. It's just a question of what's defining a vice and how do we get that data? So once I was looking at that, I realized that, we can get great data. I can now harness 20 years worth, and I repeat that, 20 years worth of quantified data for gambling, prostitution, drinking, and drugs. I mean, there's data out there, again, thanks to the internet, and it's publicly available if you know how to go after it and harness it. A lot of that is using the tools of the internet and scraping and getting a little creative at times. And what I found is when I put this together, and it's not one of these dynamic models where it reweights things. It is what it is. People spend in this way in good times and bad times. It's a very, statistically speaking, since we're both sort of number oriented, it has a correlation of almost 90, which is almost a perfect correlation, but it has that correlation to retail spending a couple months in advance. So it's not just a powerful correlation, it's a powerful correlation leading. And it's very compelling. So that's the academics, but then the question is, well, how do you go out and how do you find out what's going on with hookers? And the answer is very carefully and always legally.
Discreetly.
And, discreetly. Well, definitely my wife knows. So, recently, and I harnessed the data and I harvested, and it's been very informative. So I even did a survey over the holidays where we have your standard economic survey, like the Fed does their business outlook survey, where they go to the local manufacturers and business people once a month, and they hit them up with a survey that says, how are business conditions today? How do you see them in 6 months? What are your customers telling you? So I did the same thing, except it just so happened that the business owners I looked at happened to be escorts. Did a survey, and because I wanted to know about inflation. In fact, funny story, last year I went to the Wall Street Journal and I went to Fox News. And I said, would you guys like to kind of help me with this survey? And specifically what I'm looking for is, let's go to Larry Summers. Let's go to Krugman. Let's go to all these so-called big thinkers who think they know what's going on in the economy, and let's ask them the same questions. And I'll ask the escorts, and then we'll see who's right, 6 months down the line. I said, but here's the challenge. I kind of need a budget because I'm going to be taking up some time of these escorts. And the Wall Street Journal was great because obviously, who wants to get involved in something that's going to be, a little bit toxic and a little bit geez, we're the Wall Street Journal. Do we really want to be underwriting some kind of excursion involving, prostitutes? They demurred and just said, well, we don't have budget. Fox News, of course, was much more fun. They said, oh, yeah, well, that's because you're talking to print media. TV always has the money. In any case.
Is that the case?
Yeah, well, that's what they said. I don't know. I ended up doing it on my own. And what was interesting is I did a survey. And, there's low end, high end, and middle price points. So you can get to a fair representation. And what I found was some interesting uniformity. What I found was that everyone was saying they didn't see costs going up in the next 6 months. And at the same time, because of that, they didn't need to raise prices. So let me take a step back and what that means to me. They don't see inflation. They don't expect inflation. And so they're not responding to it, that their margins are secure at this point and predictable. The second thing that they said was, in terms of their current client demand and what they were hearing, is that it was just sort of steady as you go. There was no increase or decrease in demand. And that's interesting because, usually you might hear, well, they're having to tighten their wallet, pull back a little bit of spending, or bonus. They expect a great bonus, and so things are trying to be careful, get the right word, popping up, so to speak. No, it's steady as you go. So here we have a demand-driven situation that's constant. We have a situation where, so basically their top line expectations are basically the same as they were, and they don't see it changing in 6 months. And their bottom line is the same. And what I think is really critical here is not just what this says about inflation going forward, what they're hearing from themselves and from their clients. I think one of the most compelling things was, a lot of them said, and a lot of this is because of oil prices coming down. It's enabling their clients to maintain the spending level. So I want to really look at that if I can, Peter, if that's okay, if we have time.
Sure. Let's try to make it short and sweet.
Yeah. So basically what they're saying is, yes, everyone's out there spending money, and you would think it's inflationary, but the reality is the opposite. They're only spending money because they have this gas dividend. And it really is affecting them. As soon as gas prices stabilize or start to move up, spending's going to immediately drop. And that's contrary to what I think people are expecting. There's this expectation out there that inflation's picking up because it's demand driven. Oh my God, everyone's spending money. Well, it's actually the opposite. What's going to happen is inflation will drop away by the wayside again once we start to see any move by the Fed to raise rates, or once we see any shift in inflation. Oil prices aren't going to go down that much more. We've bottomed. I mean, we're not going to see $30 oil. 45, 50, 60, who knows? It's only going to go up. Right now, in the first half, this stuff is rippling through the economy in a positive way. Still seeing the spending. We're only now seeing things like truck rates are going down. Again, we go back to the supply side of life. Hey, it took a while for oil prices to suddenly drop and get so ingrained in expectations that truckers had to lower their prices because, their costs were down and they had to pass that along. Reality is 67% of everything in this country is shipped via truck. So you basically have lowered the cost of goods for 67% of the economy by 20%, however much it costs. And all this stuff is still rippling through the economy, but you get to the second half, it starts to play out. Consumer spending is going to retrench. And meanwhile, we have these wonderful discussions about the Fed's finger on the trigger of rate hikes. Man, I could see the Fed just all this great and positive news through June. They raise the rates. Boom. By the second half, everything's starting to fall apart. I could just see them totally misreading the situation.
Right.
And that's the opportunity, right?
Yeah.
Let me stop there and.
Sure.
You have questions? I don't know.
Yeah. Well, thank you very much for this synopsis on the Vice Index. Let's talk about what I like to do with many of the guests that come on is we play basically a word association game because there's still so many things I want to talk to you about. Unfortunately, time is, in our case, not finite. It is finite in this case. We have the issue that what I'll do is I'll just say a word, a phrase, a concept, or idea, and just tell me the first thing that comes to your mind.
Oh boy. Okay, put me on the spot.
Okay. Well, this should be easy. I'm going to throw a few softballs. Okay, so Moneyball.
Fun.
The Sloan Conference. I'm not sure if you're familiar. It just happened.
I'm not familiar with that.
It's a conference that happens on an annual basis where top people related to professional sports talk about quantitative analysis for athletics.
No way. I'm not familiar with that. I got to check out.
Oh, see, you're missing out. You can't be the Moneyball guy if you don't know about the Sloan Conference.
I got to get there. Yeah.
Okay. Next one. Big data.
Same old, same old. Wow. I don't know what to respond to that.
All right. That's good. That's fine.
Too many thoughts come to mind.
Okay. Qualitative data.
Fun color.
Okay. Your best leading indicator.
Jobless claims.
Your top investment idea.
Do we mean stock or just in general?
Whatever. Your choice.
Disney.
Econ metrics.
Useful, but really ultimately just accounting.
Information overload.
Information overload. Signal versus noise.
This conversation.
Excellent and fun. Thank you.
Thank you, Andrew.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.